Since the Christmas Eve sell-off, the S&P 500 has risen 13%, including a 5% jump on December 26th. But last week, the rally petered out and stocks ended flat. This rally has been so easy to see that even I could see it. On December 22nd, I wrote that nothing goes to hell in a straight line, not even stocks. And I wrote it because by that time, just about everything had gone down for weeks and formed a chart with a nearly straight line south. If there had been some kind of crisis, such as one of the big banks toppling, okay, this might have made sense. But this was just an overinflated market letting out some super hot air. And it was clear that as soon as that selling pressure would abate, the dip buyers, we're talking about many billions of dollars lined up at hedge funds, other institutional investors, and individual investors would jump in, much of it algo-driven. And I wrote on December 22nd that we would get a sharp rally in January. Well, it started a little early on December 26th, and it petered out a week ago. And now some of the most vocal bulls are hoping that the Fed will announce that it will reverse course or something and back off and start doing what is right, namely cutting rates and restarting QE, so that the crybabies on Wall Street can continue to make the easy money on nothing but a wing and a prayer. But that's not likely to happen, and those who expect the Fed to reverse course anytime soon will be disappointed. So what are the dynamics for stocks going forward? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, January 27th, 2019. One of the reasons the sell-off before Christmas was so vicious is something very mundane, but something we haven't had in years because there hasn't been a broad stock market loss for the year since the financial crisis. That sell-off over the 2 weeks before Christmas was fueled in part by tax loss harvesting. A lot of investors were sitting on sizable losses in some of the biggest stocks such as Apple, Amazon, Google, and Facebook. And for tax purposes, they could harvest those losses by selling those stocks before year end. But that tax loss harvesting stops right after Christmas. And then the dip buyers piled in, including algo-driven strategies by large funds. This is how it nearly always is, and why I wrote that nothing goes to hell in a straight line. After a sharp sell-off, there is nearly always a big bounce that rattles short sellers before the market is ready for the next leg down. So now, after a volatile but flat week, some of our Wall Street hype mongers are waiting for the Fed to jump in and perform some miracles in a reverse course, stop the quantitative tightening, and start QE all over again and start cutting interest rates. The Fed will meet this Monday and Tuesday, and after the meeting on Tuesday, we might get some preliminary and partial clues. One thing we know for sure, the Fed will never ever reduce its balance sheet down to where it had been before QE started in 2008. And this is for several basic reasons, including that the Fed's balance sheet grows with the economy and has always done so. The biggest reason is currency in circulation, which are the paper dollars people carry in their wallets and stuff under their mattresses. These Federal Reserve notes, as they're called, are a liability on the Fed's balance sheet, not an asset. The U.S. Treasury Department produces the notes and coins, but the Fed manages them via the banking system. There must always be enough paper dollars in the banking system to satisfy the demand by customers for physical currency. Currency in circulation grows when there's a lot of demand for paper dollars. There has been enormous demand since the financial crisis, much of it from overseas. The amount of currency in circulation has doubled since 2008 and has now reached 1.7 trillion paper dollars. At that growth rate, it may well reach 2.2 trillion in 5 years. The Fed also carries some other liabilities on its balance sheet, so total liabilities would likely be 2.4 trillion in 5 years. These liabilities are the other side of the Fed's balance sheet from its assets, and they must be counterbalanced by assets. So to counterbalance 2.4 trillion in liabilities and a very small amount of capital, the Fed would also need to have 2.4 trillion in assets on the balance sheet. Hence, the Fed will not reduce its balance sheet below 2.4 trillion. That's the floor. Now, the balance sheet is about $4 trillion. So the maximum amount by which the Fed can even reduce its stash of Treasury securities and mortgage-backed securities is by $1.6 trillion, and it has already shed over $400 billion. What the Fed will likely communicate more precisely over the next few months is how much of that $1.6 trillion in excess it will whittle down. But it cannot go back where it had been in 2008. So we're eagerly awaiting to be informed about its plans. But there are other and perhaps more important things the Fed has been kicking around for months. We know that from the speeches of various Fed governors, which is how they very carefully suggest that something is coming. Here are two of them. One, the Fed wants to get rid of its mortgage-backed securities, and for a very specific reason. They're guaranteed by Fannie Mae, Freddie Mac, and Ginnie Mae, and so the principal is essentially guaranteed by the U.S. government. These are good investments, and the market is fairly liquid. But by holding these mortgage-backed securities, the Fed has said it is selectively supporting one type of private sector debt, namely housing debt, but not other forms of debt. And this official preference skews the market in various ways, and stepping into the markets like this is just not how the Fed sees its job. There are about $1.6 trillion in mortgage-backed securities left on the Fed's balance sheet, and there is a very good chance the Fed will try to get rid of them. The Fed heads have been suggesting that, and there seems to be a consensus building in that direction. But if the Fed gets rid of $1.6 trillion in mortgage-backed securities over the next 5 years, and if its minimum balance sheet in 5 years is $2.4 trillion, down from $4 trillion right now, it would have to stop shedding Treasury securities right this moment. See what I'm saying? In order to get rid of all its mortgage-backed securities over the next 5 years, the Fed couldn't, in effect, get rid of any more Treasury securities without reducing its balance sheet below the lower limit of $2.4 trillion. So I expect the Fed to clarify its strategy concerning those mortgage-backed securities. This type of rejiggering would bring big changes to how quantitative tightening is unfolding going forward. And two, the Fed is likely to switch to shorter-term securities, such as 3-month Treasury bills, of which it has none currently. All it currently has are treasuries with longer maturities. The average maturity of its treasury holdings is over 8 years, which is very long. So if it starts replacing maturing long-term securities on its balance sheet with short-term treasury bills, it would bring down the average maturity on its balance sheet. So by stepping away from mortgage-backed securities and by replacing long-term treasuries with short-term treasuries, the Fed would introduce big changes to the balance sheet. Both of these actions would take support away from long-term securities, and long-term yields could feel upward pressure, which would translate into higher borrowing rates and in particular higher mortgage rates. So it looks like the Fed will bring the balance sheet down further from where it is today, but it might start communicating more precisely where it wants to go with its balance sheet in terms of level, maturities, and mix. We may get the first tidbits on Tuesday after the Fed meeting, and we will get more tidbits over the next few months. But those who think the Fed is going to reverse anything and restart QE and cut interest rates anytime soon will likely be very disappointed. And the stock market will likely lose that illusion shortly. In addition, the stock market will soon get a slew of data. Since late December, much of the government data, including all monthly data from the Commerce Department, the Bureau of Economic Analysis, and the Treasury Department, has been blocked due to the government shutdown. This data will not come out of the woodwork, and indications are that this data isn't going to be very good and thus disappointing. For the past 5 weeks, no data was good data, but this illusion too is now ending. So starting this week and going forward, the Fed may disappoint the markets because it'll become clear that it will not reverse anything, but that it may tweak its balance sheet in a way that might raise long-term interest rates, and markets don't like that at all. And the market will be back to its post-September 18 new normal, very volatile, with many heat-inducing ups where short sellers get taken out the back and shot, and nerve-wracking downs where dip buyers that fail to jump out in time get taken out the back and shot. All this volatility within an overall downtrend is likely what we'll see for the next few years. The reason I say that it'll last for years is because a catastrophic plunge in the market that gets all this accomplished at once and that gets the Fed back into inventing crazy experimental monetary policy on the fly to keep the financial house of cards from collapsing is unlikely. This type of plunge is unlikely because of just how powerful the dip buying is, algo-driven and backed by a huge pile of money set aside precisely for that purpose, as many investors have been expecting a long, hard sell-off and got ready for it. That money goes to work after every dip to create that bounce, but then these dip buyers jump out, especially algo-driven dip buyers, because they're not long-term investors, but short-term traders. And then the selling starts all over again. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.